So, have you ever had $100 in your pocket and wondered how you could turn it into $1,000, $10,000, or even $100,000? Sadly, this isn't something they teach in school, and honestly, it would have been pretty awesome if they did. Because of this lack of knowledge, investing feels scary for most beginners. But today, I'm going to simplify the entire process. Investing my money allowed me to become a multi-millionaire, and guess what I started with? That's right, around $100, maybe even less. I'm not saying becoming rich is easy, but by taking calculated risks, you can grow your wealth over time. Everyone has a different risk tolerance, so in this video, I'll show beginner-friendly ways to invest $100. As we move forward, the risk level will increase, but remember, higher risk can also mean higher rewards. I'll even invest $100 into each option myself so you can see exactly how it works.
When someone asks me how they should invest a $100, my first answer is always invest in yourself. Buy books, learn skills, improve your knowledge. But assuming you've already done that, let's talk about actual places where you can put your money. I'm a businessman, not a financial advisor. These are simply strategies that worked for me over the years. Also, don't worry, I'm not trying to sell you anything at the end. Just remember, if you enjoy the video, hit that like button because it helps push this content out to more people. And subscribe if you want to learn more about building wealth. The first investment is a high-interest savings account. I'd rate this a 1 out of 10 on the risk scale, basically the safest option possible. Nowadays, it's difficult to find savings accounts that pay great interest, but that's not the main reason it's on this list. A savings account helps you build an emergency fund, money you can access quickly if something unexpected happens. This can stop you from falling into debt or paying expensive loan fees. I remember when I bought my first apartment, the hot water system broke after only 2 months. Thankfully, my emergency fund covered the repair and I avoided taking out a payday loan. When choosing a savings account, I mainly look for 2 things: a decent interest rate and instant access to my money. Some good examples are Ally Bank, Marcus by Goldman Sachs, and Citibank.
Next up is gold, often called a safe haven investment. I'd rate this a 2 out of 10 on the risk scale. Since the creation of the Federal Reserve in 1913, the US dollar has lost around 95% of its purchasing power. Gold, on the other hand, has historically held its value much better over time. For example, if you owned $100 worth of gold in the year 2000, it would now be worth several times more today. The gold itself never changed. The value of money did. Gold has been trusted for thousands of years because it's rare, durable, and difficult to mine. But if it's so safe, why is there still risk? The answer is opportunity cost. While gold protects wealth, it usually grows much slower than other investments. So by choosing gold, you might miss out on bigger opportunities elsewhere. There are 2 main ways to invest in gold. The first is buying physical gold, like bars, coins, or jewelry. But usually sellers charge extra above the actual gold value. The second option is buying gold digitally through an investment app or broker. This lets you buy gold closer to its real market price and sell it more easily. Popular choices include gold ETFs like GLD. These funds hold huge amounts of real gold in vaults around the world, while investors own small shares of that gold. It's one of the simplest ways for beginners to invest in precious metals. Now, let's talk about one of the best beginner investments, low-cost index funds. I'd rate this a 3 out of 10 on the risk scale. If you invested just $100 every month into an index fund earning around 7% annually, after 30 years, you could end up with over $100,000. That's the power of compound interest. Even Warren Buffett once made a $1 million bet that a simple S&P 500 index fund would outperform professional hedge fund managers over 10 years, and he won. An index fund is basically a collection of top companies bundled together. Instead of picking individual stocks yourself, you automatically invest in companies like Apple, Microsoft, Amazon, and many more, all at once. Now, imagine your investments are left exposed without protection. Governments may tax the profits heavily. That's why many countries offer special investment accounts. In the US, it's called a Roth IRA. In the UK, it's called an ISA. These accounts allow your investments to grow tax efficiently, helping you keep more of your profits. My favorite platforms for index fund investing are Fidelity, Charles Schwab, and Vanguard. And the best part? You don't need thousands of dollars to get started, because many brokers now allow fractional investing, meaning you can invest even small amounts, like $100.
The fourth investment option is a REIT, short for Real Estate Investment Trust. I'd also give this a 3 out of 10 on the risk scale. Think of it like this. Thousands of people pool their money together to buy income-producing properties like offices, apartments, hotels, or shopping centers. The rental income generated from these properties gets shared among the investors. In simple terms, you own a tiny piece of real estate without needing to buy an entire property yourself. By law, REITs must distribute most of their profits back to investors, making them popular for passive income. Historically, some REITs have even outperformed the stock market over long periods. Next comes buying and reselling items. The risk here depends entirely on your knowledge and skill, but I'd rate it around 4 out of 10. The advantage is that you can focus on products you already understand. For me, that might be model engines or golf equipment. For someone else, it could be sneakers, Pokemon cards, or vintage electronics. The goal is simple: buy undervalued items and sell them for more. This strategy rewards people who know how to spot good deals. Sometimes you can make surprisingly large profits if you know your market well enough.
Now we're entering more serious investing territory: individual stocks. I'd rate this a 6.5 out of 10 on the risk scale. Unlike index funds, here you choose specific companies yourself. If you pick well, the rewards can be huge, but bad decisions can also lose money quickly. Years ago, I invested in tech companies during the dot-com boom and made a lot of money very fast. But when the bubble burst, some companies completely disappeared. Choosing stocks often involves studying company finances, leadership, and market trends, something called fundamental analysis. Thankfully, tools like Yahoo Finance make this much easier today. There's even an old experiment where monkeys throwing darts at stock listings supposedly outperformed professional hedge fund managers on average. So, for fun, I decided to test this idea myself. I randomly selected 20 stocks, threw a dart blindfolded, and whatever it landed on became my investment choice. Completely random, but it shows how unpredictable the stock market can sometimes be.
Now we move into speculation rather than investing. Cryptocurrency. This gets a 9 out of 10 on the risk scale. You've probably heard of Bitcoin. If you had invested $100 into Bitcoin years ago, it could have grown into thousands. But crypto is extremely volatile. People have made fortunes overnight, while others lost most of their money just as quickly. Bitcoin uses blockchain technology and operates independently of governments, which many people find attractive. But because prices move so dramatically, crypto should only be considered with money you can afford to lose. And finally, we reach the highest risk option of all, the lottery. This is a full 10 out of 10 on the risk scale, and honestly isn't something I'd recommend. Millions of people play every year because the rewards are massive, but statistically, the odds are incredibly small. To put it in perspective, you're far more likely to become famous or win major awards than actually win the lottery jackpot. For this video, I decided to buy $100 worth of scratch cards just to see what would happen. After scratching every single one, we ended up getting only around $50 back, a 50% loss. It was fun as an experiment, but it clearly shows why gambling is not a reliable path to wealth. I hope this video made investing feel less confusing and more approachable for beginners. Whether you choose savings accounts, index funds, real estate, stocks, or even crypto, the important thing is simply getting started and learning over time. If you'd like a part 2 where we check how these investments performed after a month, make sure to hit that like button and subscribe so you don't miss it. Thanks for watching, and I'll see you in the next video.